In this video, we walked through two basic note transactions for the Sean Astin Corporation. On October 1st, we issued a note to Encino Bank in exchange for cash in the amount of $50,000. It's a 12-month note with an 8% stated interest rate. On October 1st, we also borrowed money from Shore Bank by signing a zero interest-bearing note with a face amount of $54,000 and received $50,000 today. It also has a 12-month term. Let's go ahead and record the journal entries for the issuing or signing of these notes. For the $50,000 we received from Encino Bank, we debit cash for $50,000, and of course we credit notes payable for $50,000. We also received $50,000 from Shore Bank, but in this case we record the note, as we always do, at its face value of $54,000. The difference is a $4,000 debit to the discount on notes payable. Of course, the difference between the cash we receive today, $50,000, and the $54,000 we repay in 12 months represents interest on this note. Let's go ahead and prepare our adjusting journal entries for December 31st. For the money that we borrowed from Encino Bank, we need to record $1,000 in interest. This is the carrying amount of the note, the $50,000, times 8% interest, and we've had the note for 3/12 of the year. So we record $1,000 in interest expense, and we credit interest payable for $1,000. Now, from Encino Bank, we're going to pay $4,000 in interest over the 1-year period. 3 months have passed, so we'll record 1/4 of that discount as interest expense for 2020. And we debit interest expense, and we credit the discount on the notes payable. Let's go ahead now and look at how both these notes will appear on our balance sheet at year end. The money we borrowed from Encino Bank, we've got a notes payable of $50,000, and we've got an associated interest payable of $1,000 for a total liability due to Encino Bank at year end of $51,000. For the note to Shore Bank, we recorded it as face value of $54,000 and originally recorded a discount of $4,000. We've reduced that now to a $3,000 discount, so the net note payable or net liability on our books will also be the same, $51,000. Let's take a look at several additional questions. What's the nature of that discount on the notes payable? It's essentially interest. The note is recorded at its face value, and the quote prepaid interest is recorded in a discount on notes payable account. We haven't really prepaid the interest. Despite being called zero interest, the interest is still charged. It's just that we receive $50,000 up front and are going to pay back $54,000 at the end. So in terms of interest, we're going to pay $4,000 in interest over the life of the loan to Encino Bank, as well as the same $4,000 in interest to Shore Bank. The journal entries at maturity for the notes are as follows. For Encino Bank, again, we're going to pay them $54,000 in cash. And of course, we need to remove the notes payable from our books, which is on our books at $50,000. We also had a $1,000 interest accrual that we're going to want to remove from our books, as well as recording an additional $3,000 in interest expense. That's the $50,000 at 8% for the 9 months we've had the money during 2021. Now, for a Shore Bank, we're going to also pay them the same $54,000 in cash, but we're going to remove a note in the amount of $54,000 from our books, as well as a discount of $3,000. Recall, that's the remaining 9 months of the year times the $4,000 discount. So we remove the discount, as well as the $54,000 note payable. And of course, debits don't equal credits. And we've got a $3,000 debit to interest expense. And again, that's the remaining 9/12 of the original $4,000 discount.